Most people know their credit score is important. They know a good score is better than a bad one. They know it affects whether they get approved for things. They know they should probably pay attention to it. But most people don't actually understand what the score is measuring. What specific behaviors drive it up? What specific behaviors tank it? What lenders are actually seeing when they pull that number? And without that understanding, people make mistakes. Mistakes that cost them thousands of dollars in higher interest rates. Mistakes that prevent them from getting approved for mortgages. Mistakes that follow them financially for years. Today we're fixing that. What a credit score actually is. How it's calculated specifically. What lenders are reading from it. And how to use that knowledge to build and maintain excellent credit intentionally. Let's start with what a credit score is. A credit score is a 3-digit number typically between 300 and 850 that represents your credit worthiness. It's a snapshot of how reliably you've managed borrowed money in the past. Lenders use it to predict how reliably you'll manage borrowed money in the future. The most widely used scoring model is the FICO score. Here's how it breaks down. 800 to 850 exceptional. 740 to 799 very good. 670 to 739 good. 580 to 669 fair. Below 580 poor. These ranges determine what rates and terms you qualify for on loans and credit cards. The difference between a 620 score and a 760 score on a 30-year mortgage can be thousands of dollars per year in interest. Over the life of the loan, tens of thousands. Your credit score is not just a number. It's a financial multiplier for better or worse. Now, how is it actually calculated? 5 factors. 5 weights. Factor 1: payment history. 35%. The biggest single factor. Do you pay your bills on time? Every on-time payment builds this. Every late payment, even one, damages it. Missed payments, collections, bankruptcy, serious long-term damage. This is the simplest and most impactful factor. Pay every bill on time. Every single time. No exceptions. If you tend to forget, automate minimum payments on everything. Factor 2: credit utilization. 30%. This is the percentage of your available credit that you're currently using. If you have a credit card with a $10,000 limit and a $3,000 balance, your utilization on that card is 30%. The general guidance: keep utilization below 30%. Ideally below 10% for the best scores. High utilization signals to lenders that you're relying heavily on credit, which suggests financial stress. Low utilization signals you have access to credit but don't need it, which is exactly what lenders want to see. Factor 3: length of credit history. 15%. How long have your accounts been open? Older accounts and a longer average account age across all your credit are better. This is why closing old credit cards, even ones you don't use, can actually hurt your score. Those old accounts are contributing to your average credit age. Remove them and the average drops. Factor 4: credit mix. 10%. Do you have different types of credit? Credit cards, revolving credit. Auto loans, installment loans. Mortgage installment loan. Student loans, installment loans. Having a mix of different credit types shows you can manage various forms of borrowing responsibly. This is a smaller factor, but it matters at the margins for people trying to push into excellent score territory. Factor 5: new credit inquiries. 10%. Every time you apply for new credit, the lender does a hard inquiry on your credit report. Hard inquiries temporarily ding your score, typically by 5 to 10 points. Multiple applications in a short period signal financial desperation to lenders, which tanks the score further. Rate shopping for a mortgage or car loan within a short window, typically 14 to 45 days, is usually counted as one inquiry. But applying for 5 credit cards in 3 months each pulls its own hard inquiry. Apply selectively. Space out applications. So what is the credit score actually telling lenders? It's telling a story about financial behavior. When a lender sees a 780 score, here's the story they're reading. This person pays their bills on time consistently. They have access to significant credit but don't overuse it. They've maintained credit accounts over a long period. They don't constantly apply for new credit. That's the story of a low-risk borrower. Someone unlikely to default. Someone who manages obligations reliably. Lenders compete to offer low rates to this person. When a lender sees a 580 score, here's the story. Late payments possibly. High credit utilization probably. Short credit history or recent negative events likely. That's the story of a higher-risk borrower. The lender either declines or charges a significantly higher rate to compensate for the risk they're taking on. The credit score is not a moral judgment. It's a behavioral track record. And you write that track record deliberately or accidentally every single month through your financial habits. Now, how to build excellent credit intentionally. Move 1. Pay every bill on time. Always. Set up autopay for at least the minimum on every account. Never miss a payment. Payment history is 35% of the score. This single habit maintained consistently does more for your credit score than any other action. Move 2. Keep utilization low. Pay down balances, or request credit limit increases on existing cards without increasing spending. A higher limit with the same balance means lower utilization. If you have a $10,000 card with a $3,000 balance, 30% utilization. If the limit increases to $20,000 with the same balance, 15% utilization. Score improves without paying down a single dollar. Move 3. Don't close old accounts. Even if you don't use an old credit card, keep it open. The account age contributes positively to your score. If there's an annual fee, call and ask to downgrade to a no-fee version. Most card issuers will do this, preserving the account age without the cost. Move 4. Be strategic about new applications. Only apply for credit when you genuinely need it. Space out applications. Don't apply for multiple cards in a short window. Move 5. Check your credit report regularly. Errors on credit reports are more common than people realize. Accounts you didn't open. Late payments reported incorrectly. Debts that were paid but still showing as outstanding. These errors directly hurt your score and they can be disputed and removed. Check your full report at annualcreditreport.com free, 3 times per year, 1 from each major bureau. Dispute any errors immediately. Move 6. If starting from scratch, use a secured credit card. A secured card requires a cash deposit that becomes your credit limit. Use it for small purchases. Pay it in full every month. Never miss a payment. This builds payment history from zero, which is the fastest way to start a credit file. Within 6 to 12 months of responsible use, a real credit score emerges. Here's the summary. Your credit score is a 3-digit story about your financial behavior. It rewards consistency. It rewards restraint. It rewards time. There are no shortcuts to an excellent score, but there is a reliable path. Pay on time always. Keep utilization low. Keep old accounts open. Apply for new credit sparingly. Check your report for errors. Do those 5 things consistently and a strong credit score follows. And a strong credit score over a lifetime of mortgages, car loans, business financing saves tens of thousands of dollars in interest. It's not glamorous, but it's one of the highest return financial habits you can build. Hit like if this helped you understand your score better. Subscribe for the full series. Build it deliberately. Protect it consistently. Let it work for you. See you in the next one.